again, landlords of Ontario. Are you feeling financial pressure with your rental property? Is it producing negative cash flow? Well, one thing I discuss with many of my landlords is that owning a rental property, whether it's a condo unit, a house, or a small multifamily building, it is a business, and you are now a business owner. There are expenses, write offs, and tax advantages that come along with being a business owner. To many people, buying an investment property is simply to themselves their retirement plan, and that's all they treat it as. And they take the rent that they collect month after month, and they use that to pay off that property's mortgage month after month, and that's all that they do. But what they don't realize is that's not how the government is looking at their situation. To the CRA, if you go to work every single day and you make $5,000 a month, and you also collect $3,000 a month from your rental property, they see that as you make $8,000 a month in income. That's how they look at it. It doesn't matter about primary mortgage or secondary mortgage or anything like that. They strictly look at that as income, $8,000 a month. So, to help us with how we can maximize the money we keep inside our pockets and minimize what we have to give away to the government is my friend and colleague, Sylvia Ho. Sylvia is a financial landlord consultant, and she helps landlords save money and taxes. Hi, Sylvia. How are you? Welcome back.
Thank you. I'm glad to be here.
Today, Sylvia is going to speak to us about a way that we can tweak your mortgage to maximize your tax benefits available to you, and how you can then use those tax refunds to paying off your mortgage by sharing with us a scenario of a couple. We're going to call them Frank and Susan, and how they saved, and more importantly, how she can do the same for you. So, without further ado, let's dive right into this. Sylvia, the floor is yours.
Awesome. Thanks so much, Kevin. You know what, Kevin? The reality comes down to is Canadians are cash strapped, right? I
Agreed.
don't know. I don't know if you feel that, if you've heard other families say that, but Canadians are cash strapped. Like, where people are living paycheck to paycheck, they're just making ends meet, and it comes down to is the cost of living is just so high.
Agreed.
Yeah.
Agreed.
Many of my clients will say that, Sylvia, I just feel like I have no money at the end. And what I'm trying to get at is a majority of our money is going to income taxes and paying for our mortgage, hence interest to the banks. And if we can decrease the amount of income taxes we pay and decrease the amount of interest we pay to the banks, we just overall have more money in our pocket. Do you agree?
Yep, my grandma always said a penny saved is a penny earned.
Yeah, absolutely. Like just going back to like income taxes, if someone makes $300,000 a year, they're automatically at the 50% tax bracket.
Yep.
Right? They're paying $150,000 in income taxes. That's a lot of money, and this is every single year.
Yep. It is a lot of money, that's for
Yeah,
sure.
every single year. And someone, let's just say they had $500,000 mortgage, they're going to pay $1 million in mortgage payments just to pay that off over a 25 to 30 year time period, and therefore they paid $500,000 as interest, and that's just a lot of money, right?
Again, agreed. Yes. Let's save some money for our guys. How can we do that?
Yeah, so we're going to run a scenario. This is actually a live client, but we're going to change their names to Frank and Susan. Okay.
Love it.
And Frank and Susan, they make $300,000 a year. They pay income taxes of 150. We already know that. But they also have a small rental property. Okay. And this rental property came about because they used to live there pre-kids. Okay.
Yeah.
And then they're like, oh, the kids came and they're like, oh my goodness, we can't live in this small condo. We need to upgrade.
That's one of the easiest ways to get your first rental properly, actually, is to keep your first starter home, right? And then move on, whether it's two individuals that had starter homes that came together and move on, sell one, or just like this scenario here where they're keeping one. Anyways.
I absolutely agree with you. But the thing is, Kev, a lot of people believe that they must sell their homes in order to upgrade to their new home, right? But what I'm going to say is I'm going to say the opposite. I go, well, we don't know that. We don't know if that's true, really, really true. You don't have to make a ton of money, but definitely we have to qualify now for 2 mortgages. And so a lot of people feel that they have to sell, but I say that, hey, until you know the numbers, until you know whether the banks will lend you 2 mortgages, you don't know for sure. Okay.
Yes.
And me being a mortgage agent and a financial landlord consultant, that's what I do. I help clients run those numbers. All right. So Frank and Susan, they decided to keep their condo. They were able to upgrade. And over the years, rates went up, condo fees went up, property taxes went up, their income went up, and then they ended up going into negative cash flow. And right now, in the scenario, they're in negative cash flow of about $300 per month. Okay. Now, for this particular family, they're like, oh, it's $300 per month. The thinking behind it is that it's okay. We're $300 per month. We make 300 grand. We can afford it, right? This is for long-term investments. And I get that thinking because I used to think that way as well, right? But there's actually a better way to use the current money that they have coming in. And that's what I'm going to talk to you about today. And this better way is an advanced financial strategy that's used by wealthy Canadian landlords to save money, and basically to cut the income taxes that they pay the government legally, right? And to pay less interest to the banks. And when I'm going to go over the numbers right now, I'm a numbers person. I love numbers. And this is how a typical client would get a plan for me. Okay.
Perfect. Yeah. And just so you know, I know that we're on all different platforms here, but if you're a numbers person as well and you want to watch these numbers along with while Sylvia is watching this, you can also check us out on YouTube instead of just the audio platforms that we're on. But there will be these numbers displayed on the YouTube channel. But if not, listen carefully and we'll try to go over these numbers as slow as possible so that everybody understands what Sylvia is talking about.
This family, Frank and Susan, they make $300,000 a year. We already know they pay $150,000 in income taxes. So what I'm going to do is I'm going to show you and demonstrate how we're going to get back some of that hard-earned money back into their own pocket. Frank and Susan, they own a house right now because they've upgraded, right? And this house is worth $1.2 million. And they have a mortgage of $580,000, and they're currently on an amortization of 27 years, which means that it will take them 27 years to pay off this 580.
Yep.
Yeah, we're good.
Yep.
With this advanced tax strategy, Kev, we're going to get them down to below 18 years.
Love it. Let's see this.
Pretty incredible, right? Okay, so here is the family budget. This family has that mortgage of $580,000. They're making payments of $3,400 per month. Of course, we have to pay property taxes, right? $500 per month. They have to pay for insurance and utilities. That's another $600 a month out of their pocket, as well as this particular family. They have 2 car loans. $650 per month for these 2 car loans. And those car loans totaled up to 40 grand. So every single month out of their pocket is their mortgage payments, property taxes, house insurance, utilities, and car loans is $5,150.
So just to get the large numbers correct, our family combined makes $300,000 total income. They have a current mortgage of $580,000 on their primary residence, and their monthly expenses are $5,150.
Correct. Yeah. And this $5,150 is just for the owner-occupied home, right?
Okay.
Remember, they're in negative cash flow. So let me go over the numbers for the rental property, their condo. So their mortgage payment, property taxes, condo fees, and insurance, the total expenses for this rental property is $2,772. Let's just call it $2,800. It doesn't matter. $2,772, right? They're getting their rental income of $2,500, and therefore they're in negative cash flow of $272. And this is what they've been bringing out of their pocket from their T4 income. All right? Okay.
Yep.
So their total family budget is the $5,150 plus the $272. So that just comes under $5,500. We're following along so far?
I'm with you, yes.
Yep. Okay, perfect. So when a client works with me, we always look at this. We always look at what their budget is today. Okay. And then the second step of working together is we look at, I will do a mortgage audit and a cash flow audit. So when I work with landlords, we're going to go over your cash flows and we're going to figure out your mortgage situation. And this is where, 24 years of being a mortgage agent, I put on my mortgage agent hat and I was like, okay, this is the type of product you're in. There may be, or there is a better product out there, and this is what I'm going to recommend. Okay.
Yep.
So here we go. I am going to go from a $580,000 mortgage up to a $620,000 mortgage. And the reason I'm increasing it by $40,000 is because I want to get rid of that car loan.
Okay.
By getting rid of that car loan, we're going to free up $650 a month in mortgage payments. And this is like the number one killer for building wealth is car loan payments, credit card debt, and line of credit debt, because our after-tax dollars ends up going to pay that debt. If we consolidate it all, we can start fresh. And then now we're starting at a 30-year amortization. And you're like, well, Sylvia, we just went backwards. We just went from 27 to 30. But hang tight. I'm going to show you how to get from 30 back down to 17.75 years with this strategy. Sounds good?
I'm with you. Yep.
Yep. Okay. So we've paid off the car loan because we've increased the mortgage payment. And now the mortgage payment, instead of $3,400 per month, it's gone up to $3,480. It only costs them $80 more to pay off the $40,000 in car loans. Of course, they still have to pay their property taxes, their house insurance, and utilities, but they have no more car loans. And that's what I've highlighted here in yellow. So the total family expenses is now $4,580.
Nice.
So we've decreased it by $600 per month. $650 per month, which is a car loan payments. And then the second part of my audit is to look at the mortgage product that they have on the current rental. So what has happened with this current mortgage product? Well, because they owned the condo previously, they've just been running their current amortization. And their current amortization was sitting them at a 20-year amortization, meaning that in 20 years, they'd pay off this condo. But that's the wrong thing to do, Kevin. And a lot of, I see this constantly with a lot of current landlords, is they put the amortization on their rental property really, really low. And the government loves you for that because you're actually paying more income taxes. So please, my friends, stop doing this. What you're going to do instead is you're going to take the mortgage on your rental property and you're going to re-amortize that back to a 30-year amortization. By doing this, it puts more money in your pocket and it puts less money in the government's pocket in the form of income taxes, because by going to a 30-year am, you're going to have more interest write-offs, right?
I was just going to say that interest is a taxable write-off business expense. So we always want to have our investment properties at as much leverage as possible while we're paying down our primary, which is where you're headed with this. So yeah.
Exactly. So what has happened now? The mortgage payments on the condo went from $1,822 down to $1,683. So now with all of the rental expenses and the rental income $2,500, they're only at negative cash flow of $133. So they've positioned themselves they put themselves now into much better position. So the total family budget is $4,713. How does that sound?
Yeah, it's almost $1,000 in savings.
Yep. It's actually $709 in cash flow savings just by doing this mortgage audit and cash flow audit. Okay.
Yep.
So the last step, the fun step, is how are we going to apply this advanced financial strategy? So in our first podcast that we talked about this advanced financial strategy called rental cash damming. If you want to learn more in a 1-hour webinar, you can go to cashdam.ca, where I will go over the exact blueprint on how to do it. Okay.
Yeah. Again, folks, remember everybody's situation is different. Your income, your properties, the whole financial scenario needs to be looked at so that we can figure out what makes the most amount of sense for you. So that's why checking out Sylvia at her website is a great place to start. Again, it's www.cashdam.ca, or again, you can always connect with us and I can get you in touch with Sylvia as well.
Beautiful. So rental cash damming is an advanced financial strategy that is approved by CRA, The wealthy Canadian landlords have been doing it for decades to save money and save taxes, but us middle-class landlords don't know what we don't know, right? So if we don't know the strategy exists, we're not going to ask questions about it, right? So my job as a financial landlord consultant is to tell Canadian landlords across Canada about this strategy called rental cash downing. So this is what's happening right now. This particular family, we moved them from 27 years up to a 30-year amortization. By applying this specific financial strategy, they're going to get an extra $112,000 in extra tax refunds. This is money that they weren't expecting. So I call it free money. And the reason the government is giving you back your hard-earned tax dollars is because you've applied this strategy that CRA has approved. And CRA will say at the end, like when you do your taxes, they'll be like, oh, you've actually overpaid us in income taxes. We're going to give you some money back. Right?
Yeah, because that happens often.
Exactly, right? So CRA's job is actually to keep this program hush-hush because they lose money on it. They don't want to tell people about it. And that's probably why you haven't heard about it, right? So in this case, Susan and Frank are going to get $112,000 in total tax refunds over the 17-year period. But this is where the key component comes in. Instead of taking 30 years to pay off this mortgage because we've done a debt consolidation, it's only 17.75 years. Pretty good, right?
Yeah, you almost cut that in half.
Almost. We're getting close. So they've essentially paid off from 27 years down to 17, 18 years. They shaved off 9 years worth of mortgage payments.
Yeah.
That's a lot of money, right? And that 9 years worth of mortgage payments is essentially over $500,000 in mortgage payment savings.
Wow.
Crazy. And keep in mind that this $511,000 of savings of future mortgage payments that they don't need to make anymore, even though they have committed in making it, they can redirect this $500,000 now towards your retirement savings. Right?
Yeah.
They can take this money. So from year 17.75 all the way to 30 years, because they've already committed in making those mortgage payments, they're going to redirect their mortgage payments towards their retirement. A lot of money, that's for sure. So $511,000. Another way to think about these future mortgage payments saved is, Kev, do we make our mortgage payments with after-tax dollars?
Yes.
We do, right? So
yes, we do.
Let's just say we make $1 million and then we get $500,000 in our pocket to make these mortgage payments. So this future mortgage payments that we've saved is essentially $1 million worth of income you would need to make these mortgage payments. And then, of course, because this family decided to keep their rental property, the future value of this rental property is $1.2 million. Right?
Yeah, no, it's real estate's all about longevity, right? It's a hold game, and this is interesting where you can hold more properties, pay them all down at a strategic way, so that again you're keeping the most amount of money in your pocket. I love it, Sylvia.
Yeah, and do you know the real kicker about this entire exercise is that I have not asked this family to bring out any more money than they're currently committed in doing. So right here, I have same family budget. Everything that we talked about, it's exact same family budget that the current family has, that we talked about right from the beginning. Nothing has changed. All I've asked them to do is just reallocate, rearrange the way that they're using their money and to use it more wisely. And then they get to mortgage freedom 9 to 10 years earlier than planned. How amazing is that?
That's definitely amazing. And I think actually, if I remember, there was a savings. No, not only the same family budget, they were actually spending less money every month, which would allow them to do more things that their family couldn't do regularly. Yeah.
They can choose. Now they have more power within their control about what they want to do in regards to their family budget. It's a powerful strategy, Kevin. And when I show these numbers to a client in our first initial chat, right? People are blown away. They're like,
No.
what? I'm going to save $500,000. Like, why am I not doing this? I wish I heard about you earlier, Sylvia.
Well, you said it earlier, and it's you only know what you know, and we don't know what we don't know. And
Mhm.
this is definitely something that everybody should know. So, if you're a landlord, share this strategy, share this idea. Let's get you connected with Sylvia so that you can figure out how you can start saving yourself some money monthly, annually, overall. Let's keep some money in your pocket instead of giving more to the government than what we absolutely need to.
Mhm.
Um, do you want to wrap up with anything there, Sylvia?
Yeah. You know what? Connect with me. Watch my webinar. Go to cashdam.ca, cashdam.ca, and watch the 1 hour training. It goes through the exact blueprint on what you have to do to apply the strategy. The way I explain it in my webinar, it's pretty easy. It sounds pretty straightforward. But to be honest, it's not just a push of a button. And then book an appointment with me, and then I can show you what your exact numbers are and how much money you're literally leaving on the table. And you can already tell it's hundreds of thousands of dollars. It's not 5 to 10,000, but hundreds of thousands of dollars. So please connect with me. I love to chat with you.
Yeah.
And that's
So
it.
there you go, folks. That's Sylvia Ho, the cash damming expert, saving hundreds of thousands of dollars for her clients in their mortgage strategy. I want to thank you so much for listening. And now you guys are the ones that know about this that you didn't normally know. But, anyways, thanks so much for watching this episode, and we'll see you next time. Bye for now. Hey, everybody. Thanks so much for joining us this week. I hope you enjoyed the episode. If you're finding it informative and useful, make sure to like, subscribe, share with a friend so that we can keep getting the information out there to Ontario landlords. And keep on joining us. We'll see you next time.